You check your portfolio. Up 12% this year, up 14 last year, up 19 the year before that. 3 straight years of double-digit gains. Volatility? What volatility? The VIX is sleeping. Credit spreads are tighter than a drum. Everything feels stable. Everything feels safe. And that's exactly when the floor drops out. Not because markets are predictable, but because the infrastructure holding everything together has fundamentally changed in ways most people don't see until it's too late. The next time markets break, they're going to break faster, harder, and in ways that don't match any historical playbook you've studied. And the warning signs are already flashing if you know where to look. My name is Alex, and I've spent the last decade analyzing market structure, liquidity dynamics, and the invisible plumbing that keeps global finance functioning. Most people focus on what's happening in markets. I focus on how markets actually work. And right now, the how has changed so dramatically that the old rules about crashes, corrections, and recoveries don't apply anymore. If you want to understand what's actually happening beneath the surface of market movements, hit that subscribe button. And if this video helps you see the warning signs before everyone else, give it a thumbs up so more people can find this information before they need it. Here's what we're going to cover. I'm going to show you why the next market stress event could unfold faster than anything we've seen in previous decades. Not because I'm predicting a crash, I'm not. I'm showing you how structural changes have made the entire system more fragile in specific, measurable ways. We'll examine the debt foundation that's larger and growing faster than ever before. We'll look at the derivatives layer that's expanded beyond what most people realize. We'll explore how passive investing has transformed market dynamics in ways that amplify both rises and falls. And I'll give you the specific warning signs to monitor so you can see stress building before it becomes a crisis. This isn't about fear. This is about frameworks. Let's get into it. Here's the context that matters. Through 2025, markets have delivered their third consecutive year of double-digit gains. The S&P has climbed relentlessly. Volatility has been suppressed to levels that would have seemed impossible a few years ago. Credit spreads, the premium investors' demand for taking on risk, are near all-time lows. In other words, the market is pricing in almost zero chance of anything going wrong. Historically, these conditions have preceded stress, not caused it. Preceded it. Low volatility doesn't guarantee a crash, but it does indicate that markets have become complacent, that investors have stopped pricing in risk, that the collective memory of what can go wrong has faded. But here's what makes this moment different from previous periods of low volatility and high confidence. It's not just investor psychology that's changed, it's the actual structure of markets. The plumbing. The mechanics of how money flows, how trades execute, how liquidity appears and disappears. 3 massive structural shifts have occurred over the past 15 years, and they've all converged at the same time. That convergence creates conditions where stress, when it arrives, moves faster and hits harder than historical precedents suggest. The first structural shift is debt. Not just that there's a lot of it, there's always been a lot of it, but the pace of accumulation and the global scale have reached levels that dwarf previous cycles. According to the Institute of International Finance, global debt hit $346 trillion in the third quarter of 2025. That's up $26 trillion in just 9 months, the largest 9-month increase since 2008. Let that settle for a moment. $26 trillion added to the global debt pile in 3 quarters. The United States is adding roughly $1.8 trillion annually to its debt load, which now sits at $38 trillion. Japan's debt-to-GDP ratio is at 230%. And this isn't just a developed market phenomenon. 80% of the global economy is carrying higher debt loads, growing faster than before previous downturns. Debt itself isn't inherently bad. Debt becomes a problem when growth slows, when rates rise, or when refinancing becomes difficult. And right now, all 3 of those conditions are either present or looming. What happens when debt loads are this high and something disrupts the ability to service that debt? Defaults cascade, credit spreads blow out, liquidity evaporates. And because the debt is interconnected through the global financial system, stress in one area spreads rapidly to others. The speed of that spread is what's changed. We'll come back to why in a moment, but first, you need to understand the second layer. The second structural shift is derivatives. According to the Bank for International Settlements, over-the-counter derivatives hit $846 trillion in notional value as of June 2025. That's up 16% year over year. the largest annual increase since 2008. 670 trillion of that is interest rate derivatives. These are contracts that pay out based on movements in interest rates. And here's the thing about derivatives, they create leverage, they create interconnectedness, and they create hidden exposures that don't show up until something breaks. Four banks in the United States hold 87% of the industry's $210 trillion in notional derivatives exposure. Four banks, 87%. This is concentration risk on a scale that should make anyone nervous. When one of those banks has a derivatives book go sideways, the exposure doesn't stay contained. It ripples through counterparties, through clearinghouses, through funding markets. The system is interconnected in ways that make it nearly impossible to isolate risk. Now, most of these derivatives are hedges. They're insurance policies against rate moves, currency fluctuations, credit events, but insurance only works if the counterparty can pay. And in a stress scenario, when multiple positions are moving against you at once, even well-capitalized institutions can find themselves scrambling for liquidity. The speed at which that scramble happens has accelerated because of the third structural shift. The third structural shift is passive investing. 55% of US equity assets are now in passive strategies. Index funds, ETFs, algorithmic strategies that track benchmarks rather than pick individual securities. A study published in March 2025 by researchers Jiang, Vianos, and Zheng found that passive flows create what they call amplification loops. When money flows into passive funds, those funds buy the underlying index components regardless of valuation. That pushes prices up. Higher prices attract more inflows. More inflows push prices higher still. It's a self-reinforcing cycle on the way up. But here's the problem. It works in reverse on the way down. When money flows out of passive funds, those funds sell the underlying components regardless of valuation, fundamentals, or outlook. That pushes prices down. Lower prices trigger more outflows. More outflows push prices lower. The same amplification that created the rise accelerates the fall. The study found that passive flows reduce liquidity, increase volatility, and elevate valuations beyond what fundamentals justify. Index funds buy and sell together, which means diversification benefits erode. The market becomes more susceptible to shocks because there are fewer active participants providing liquidity when passive flows reverse. Now combine these three shifts. You have record debt that needs constant refinancing. You have a massive derivatives layer that creates leverage and hidden exposures. And you have a market structure where more than half of equity assets move together based on flows rather than fundamentals. What does that create? A system where stress propagates faster than it used to. A system where liquidity can evaporate almost instantly. A system where small disruptions can cascade into large dislocations before anyone has time to react. If you've made it this far, you're already ahead of 90% of investors who think markets work the same way they did 20 years ago. But don't stop now, because what comes next is how these structural changes interact with concentration risk to create conditions that are objectively more fragile than previous cycles. Let's talk about concentration. The Magnificent Seven, those 7 mega-cap tech stocks, represent between 34 and 37% of the S&P 500 as of December 2025. The top 10 stocks represent 39%. That exceeds the 27% concentration peak during the 1999 to 2000 tech bubble. Think about that. We're more concentrated now than we were at the peak of the dot-com mania. And here's what concentration does to market dynamics. It narrows the number of stocks that matter. Between 2023 and 2024, only 27 to 28% of stocks in the S&P outperformed the index. That's the narrowest breadth since 1998 and 99, which means most of the market's gains came from a handful of names. When those names stumble, the entire index stumbles. And because passive funds are mechanically buying those names in proportion to their market cap, the concentration intensifies. More money flows into the largest names simply because they're the largest. Not because they're undervalued. Not because their fundamentals improved. Just because they're big. This creates a liquidity illusion. Markets look liquid when passive inflows are steady. Spreads are tight. Depth looks solid. But that liquidity is conditional. It depends on passive flows continuing. The moment flows reverse, the liquidity disappears because passive funds are selling mechanically, not providing liquidity. And there are fewer active buyers to step in because so much capital has shifted to passive strategies. We saw this dynamic play out in April 2025 in the Treasury market, which is supposed to be the most liquid market on Earth. Bid-ask spreads doubled. Order book depth hit the lowest level since March 2023. Yields surged 30 basis points in a matter of days. Why? Because hedge funds had built up more than $1 trillion in basis trades, strategies that profit from tiny mispricings between cash treasuries and treasury futures. When volatility spiked, those trades unwound rapidly. Firms that provide liquidity, the principal trading firms and market makers, pulled back. And suddenly, the most liquid market in the world wasn't liquid at all. The Fed's Standing Repo Facility, which provides emergency liquidity to financial institutions, saw a $29.4 billion operation in October 2025. That was the largest operation in over 20 years. In December 2025, the Fed removed the $500 billion daily limit on that facility. Why would they remove the limit unless they were concerned that $500 billion might not be enough in a stress scenario? That's not a signal of confidence. That's preparation for something bigger. Here's where policy constraints make everything more fragile. The Federal Reserve funds rate is currently at 3.5 to 3.75%. In previous recessions, the Fed typically cut rates by 5 percentage points or more to stimulate the economy. They don't have 5 points of room right now. If a downturn arrives, the Fed's primary tool, rate cuts, is limited. The balance sheet still sits at $6.6 trillion despite quantitative tightening, and the dot plot projections show only one rate cut expected for 2026. The Fed has less ammunition than it's had in decades. Meanwhile, credit markets are flashing warning signs that most people are ignoring. High yield spreads, the extra yield investors demand for buying junk bonds instead of treasuries, are at 2.8 to 2.9%. The all-time low was 2.4% in 2007. We're within half a percentage point of the tightest spreads ever recorded. That means investors are pricing in almost zero chance of defaults, almost zero chance of stress, almost zero risk premium. But look at what's coming. Corporate debt maturities are $642 billion in 2025, $930 billion in 2026, and $860 billion in 2027. 85% of that debt will refinance at higher rates than the original borrowing. For companies that took advantage of ultra-low rates during the pandemic, that refinancing wall is going to hurt. Net interest expense is going up, free cash flow is going down, and for over-leveraged companies, the math stops working. Consumer credit is already showing cracks. Delinquencies are at the highest level since 2011. Credit card balances are at record highs, and savings rates have collapsed as consumers burned through pandemic-era excess savings. When consumers are tapped out and corporations are facing higher debt service costs, where does the economic growth come from? That's the question nobody wants to answer. Now let me tie all of this together, because when you see how these pieces interact, the fragility becomes obvious. You have record debt. You have a derivatives layer that amplifies moves. You have passive flows that create mechanical selling pressure. You have concentration in a handful of stocks. You have credit spreads that price in zero risk. You have a Fed with limited ammunition. And you have liquidity that's conditional on flows continuing. The real magic, or in this case, the real danger, is in how these dynamics interact. Algorithmic trading and passive flows create what I call liquidity mirages. Everything looks fine when flows are positive, spreads are tight, markets are calm, depth looks solid. But the moment flows reverse, the liquidity disappears faster than it used to. Principal trading firms, the high-frequency traders who provide liquidity in normal times, withdraw during volatility because their risk models tell them to step back. ETFs start trading at discounts to net asset value because there aren't enough buyers. Margin calls cascade faster in derivatives markets because positions are larger and more leveraged. And there are fewer active participants willing to step in and buy the dip because so much capital is locked in passive strategies that are mechanically selling. The result is that falls happen faster. The circuit breakers, the mechanisms designed to slow down crashes, get tested more frequently because the velocity of moves has increased. And recoveries take longer because the damage is deeper and the trust evaporates more completely. Almost there. But before I wrap up, I need to show you the observable warning signs you should be monitoring. Because this isn't about predicting when something happens, it's about recognizing when conditions are deteriorating so you can adjust before everyone else panics. First warning sign, credit spreads widening by 100 to 150 basis points or more. That's the market repricing risk. When junk bond spreads blow out from 3% to 4.5 or 5%, it means investors are suddenly demanding a much higher premium for taking on credit risk. That doesn't happen in isolation. It signals stress in corporate balance sheets, concerns about defaults, or fears of economic slowdown. Second warning sign, Treasury market stress. Watch bid-ask spreads. Watch order book depth. Watch repo rates. When spreads widen, when depth thins, when repo rates spike, it means the most liquid market on earth is having trouble functioning. The Brookings Institution and the New York Fed both publish regular analysis on Treasury market functioning. That's your canary in the coal mine. Third warning sign, VIX backwardation. The VIX measures expected volatility. Normally, longer-dated VIX futures trade at a premium to near-term futures because uncertainty increases over time. When that flips, when near-term futures trade higher than longer-term futures, it signals that the market expects imminent volatility. That's backwardation. And it typically shows up right before sharp moves. Fourth warning sign, prime broker margin calls rising. When hedge funds start getting margin calls, it means their positions are moving against them and their brokers are demanding more collateral. That forces selling. Forced selling creates more volatility. More volatility creates more margin calls. It's a feedback loop. Fifth warning sign, dealer treasury inventories declining while issuance is elevated. Dealers are the intermediaries who buy treasuries at auction and distribute them to investors. When dealers are reducing their inventories despite heavy issuance, it means they're not confident they can offload that inventory. That's a liquidity problem. Sixth warning sign, passive fund outflows coinciding with money market fund spikes. When investors are pulling money out of equity ETFs and piling into money market funds, they're moving to cash. They're reducing risk. That's a clear signal of fear. And when passive funds see outflows, they have to sell the underlying holdings, which amplifies downward pressure. These warning signs form a mosaic. No single signal tells you everything. But when multiple signals flash at the same time, when credit spreads are blowing out and treasury markets are stressed and passive flows are reversing and margin calls are rising, that's not a coincidence. That's systemic fragility revealing itself. And the lesson from every previous crisis is that by the time all the signals are flashing, you're late. The time to adjust is when only some of the signals are present, when the conditions are deteriorating, but before the panic starts. The Financial Stability Oversight Council, in their December 2025 annual report, specifically highlighted concerns about liquidity mismatches in open-end funds, risks from elevated leverage in hedge funds, and vulnerabilities in treasury market structure. When the official regulatory body tasked with monitoring systemic risk is publicly stating concerns about these specific areas, you should pay attention. They don't publish those warnings for fun. They publish them because they see the same fragility everyone else is trying to ignore. Here's what all of this comes down to. The next market stress event, whenever it arrives, is going to unfold in ways that don't match historical templates. It's going to move faster because algorithmic and passive flows accelerate momentum. It's going to hit harder because leverage and derivatives amplify moves. And it's going to reveal liquidity problems that weren't visible in previous cycles because market structure has fundamentally changed. This isn't prediction. This is observation. The conditions are measurable. The vulnerabilities are documented. And the warning signs are definable. You can't control when stress arrives. You can control whether you're paying attention to the signals that precede it. You can control whether your portfolio is positioned for conditions as they actually exist rather than as you wish they existed. And you can control whether you're one of the people who sees the warning signs early or one of the people who asks what happened after it's already too late. Markets, inflation, Fed policy, liquidity dynamics, what's the next topic you want me to dig into? Drop it in the comments. I read every single one, and your questions directly shape what I cover next. Your future wealthier self is counting on you to pay attention to structure, not just headlines. Because when everyone else is ignoring the plumbing until it breaks, you'll be the one who saw it coming. You're not pushing that boulder uphill anymore. You've built a system where you can see the cracks forming in the foundation before the structure collapses, and that makes all the difference.